Imagine waking up to a breaking headline that the supreme leader of Iran has died, and within minutes the price of oil starts to spike. The London Stock Exchange trembles, and European families feel the first sting of a new wave of inflation. Could a single death in Tehran become a financial earthquake for London and the European Union? If you've ever wondered how a political shock halfway around the world can hit your wallet, stay with me, because this story is about to unfold like a domino cascade. I'm part of a team that watches the crossroads of geopolitics and markets, and the rumors swirling around the health of the supreme leader have been louder than ever in recent weeks. The timing is crucial. Tensions in the Middle East are already high, sanctions are tightening, and global energy markets are walking a tightrope. In the next few minutes, we'll explore why the supreme leader is more than just a religious figure, what happens inside Iran when that seat becomes vacant, and how the ripple can travel all the way to Canary Wharf and the streets of Paris. I'll break it down into 4 clear parts: the power that the supreme leader wields, the possible paths of succession, the immediate domestic fallout, and finally, the channels through which Europe could feel an economic shock. Drop a lightning bolt emoji in the chat if you think a single death can reshape global markets. I'm curious to see how many of you are ready for a deep dive. First, let's talk about why the supreme leader matters beyond politics. In Iran, the highest authority sits at the top of a web that stretches through the armed forces, the judiciary, the media, and the nation's most lucrative industries. The supreme leader is the commander-in-chief of the Revolutionary Guard, a force that not only runs Iran's elite military units, but also controls a vast network of overseas businesses and sanctions evasion schemes. He also appoints the heads of the judiciary, which means he can shape the legal environment for foreign investors overnight. The media landscape is another lever. State television, newspapers, and internet filters all answer to his office, shaping the narrative both at home and abroad. When you compare that to the president, who handles day-to-day administration, the contrast is stark. The president is more like a manager, while the supreme leader is the owner with veto power over every major decision. The institutional safeguards that surround this role are designed to keep the position stable, but they also create a bottleneck for change. The Assembly of Experts, a body of senior clerics, is the only group constitutionally empowered to appoint or dismiss the supreme leader. Historically, they have acted more like a rubber stamp than a true check, but the process does provide a formal pathway for transition. Behind the scenes, there are guardian councils and the Revolutionary Guard's leadership that can apply pressure to steer the outcome in a direction that protects their interests. This combination of formal and informal mechanisms means that any change at the top is rarely smooth. It's a negotiation among powerful factions, each with its own agenda. Now, let's look at the economic reach of the supreme leader. He holds direct stakes in the National Iranian Oil Company, the entity that controls the country's oil and gas reserves, the lifeblood of Iran's export earnings. He also oversees the so-called bonyads, a collection of charitable foundations that in reality manage assets estimated at well over $100 billion. These foundations own everything from real estate to manufacturing plants, and they are largely immune to external oversight. When sanctions bite, the supreme leader's networks become the channels through which oil finds its way to buyers in Asia and Europe, often through complex ship-to-ship transfers. So when the head of that network disappears, the entire system feels the tremor. If the supreme leader's death were confirmed, the first question is who steps into that role? There are 3 broad scenarios that analysts keep debating. The first is a hardliner, someone entrenched in the Revolutionary Guard, who would likely double down on regional proxies and tighten internal repression. That path would keep the current sanctions pressures, but could also provoke more aggressive posturing in the Persian Gulf, raising the risk of a naval confrontation that would spook oil markets. The second scenario is a reformist or technocrat, perhaps a senior cleric with a more pragmatic view of the economy. Such a figure might entertain limited economic reforms, potentially easing some sanctions, but would still have to navigate a hostile conservative establishment that could block any meaningful change. The third and most volatile possibility is a power vacuum, where rival factions within the clerical establishment and the guard clash over control. In that chaos, street protests could erupt, the media could be shut down, and the oil export infrastructure could be sabotaged or temporarily halted for security reasons. The immediate domestic signals would be dramatic. We would likely see nationwide mourning ceremonies, massive rallies proclaiming the martyrdom of the leader, and a sudden blackout of dissenting voices. The Tehran Stock Exchange, which has historically reacted sharply to political upheavals, would probably experience a sharp dip as investors panic over the uncertainty of policy direction and the potential for sanctions to tighten further. Historically, when the previous supreme leader passed away in the early 1980s, the market fell by more than 10% in a single day, and a similar reaction could happen now, amplified by today's more interconnected global finance. Oil production could also be hit. The Revolutionary Guard controls key export terminals on the Persian Gulf, and any security concerns could lead to temporary shutdowns of loading facilities. Even a brief interruption of a few days can send crude prices soaring because the market is already tight after years of supply cuts. Moreover, the networks that the Supreme Leader's office uses to evade sanctions could be disrupted, causing a scramble among buyers and sellers to secure alternative supply routes. Those disruptions ripple outward, affecting futures contracts on the London International Financial Futures and Options Exchange, and ultimately influencing the price consumers pay at the pump in Europe. Now think about the channels that could carry this shock all the way to London and the Eurozone. First, oil price spikes directly raise the cost of transportation, heating, and manufacturing across the continent. Higher energy bills translate into higher consumer price inflation, which central banks are already battling. If inflation climbs faster than expected, the European Central Bank might be forced to raise interest rates sooner, tightening credit conditions for businesses and households alike. Second, the volatility in oil markets often triggers capital flows away from risk-on assets and into safe haven currencies like the US dollar or Swiss franc, which can weaken the euro and increase the cost of imports. Third, the uncertainty could scare European investors out of emerging market funds, prompting a sudden outflow of capital from Iran-related equities and bonds, and potentially creating a spillover effect into other frontier markets. Finally, any escalation of military tension in the Gulf could threaten shipping lanes, prompting insurance premiums for maritime freight to rise, which again adds cost to European supply chains. All of these mechanisms show that a leadership transition in Iran is not just a regional story. It is a potential catalyst for a broader economic shock that could reverberate through European markets. The question now is, how prepared are policymakers and investors for such a scenario? What safeguards can be put in place to cushion the blow? And most importantly, how will ordinary Europeans feel the impact in their daily lives? I want to hear from you. What do you think would be the most likely outcome for Europe if oil prices were to jump dramatically tomorrow? Share your thoughts in the comments. I'm really interested in your perspective. If you're finding this analysis eye-opening, consider hitting that like button. It helps the channel keep bringing you deep dives like this. And if you want to stay ahead of the curve on how geopolitics shapes your wallet, go ahead and subscribe. We've got a lot more to unpack in the next segment. The reality is that policymakers in London and Brussels have already run a series of contingency drills for exactly this sort of shock. But the depth of those exercises often stops at the level of oil price spikes and currency volatility. What they rarely model is a full-blown leadership vacuum that triggers a cascade of political and military moves across the Gulf, forcing markets to react not just to price signals, but to real-time risk assessments of supply chain security. In practice, that means that the European Central Bank, the Bank of England, and even the Federal Reserve would be forced to coordinate their monetary responses more tightly than they have in recent memory, because the usual playbook of tweaking rates in isolation would leave the Eurozone exposed to a sudden surge in imported inflation. One of the first levers that could be pulled is a targeted easing of monetary policy aimed specifically at sectors most vulnerable to a jump in energy costs, transport, heavy industry, and even food logistics. By providing cheaper financing to companies that are forced to absorb higher fuel expenses, central banks could blunt the pass-through of higher oil prices into consumer goods. At the same time, they would have to balance that against the risk of stoking further inflationary pressure, a dilemma that will likely dominate policy debates in the weeks following any confirmation of a leadership change in Tehran. On the fiscal side, the British Treasury and the European Commission have both signaled a willingness to deploy strategic reserves more aggressively if market signals suggest a sustained supply squeeze. In the United Kingdom, the national strategic reserves of oil and gas could be released in a measured fashion to keep domestic pump prices from soaring overnight, while the European Union could tap into its own collective emergency storage mechanisms. Such releases, however, are not without political cost. They require delicate coordination among member states that each have their own domestic pressures, and any perception of uneven distribution could spark a new round of intra-European tension. Beyond the immediate monetary and fiscal tools, there is a growing consensus among risk management professionals that diversification of energy sources must accelerate. Europe has already begun to reduce its dependence on Middle Eastern crude by expanding liquefied natural gas imports from the United States, Qatar, and even emerging African suppliers. If the leadership transition in Iran leads to a prolonged period of uncertainty, we can expect to see an even faster pivot toward renewable energy projects, both as a hedge against geopolitical risk and as a response to the climate commitments that many European capitals have pledged to meet. In practical terms, that could mean a surge in public and private investment in offshore wind farms, solar arrays, and battery storage facilities, all of which would create new jobs and help insulate the economy from future oil price shocks. From the perspective of investors, the most prudent approach would be to rebalance portfolios toward assets that historically perform well during periods of heightened geopolitical tension. Historically, safe haven currencies such as the Swiss franc and the US dollar tend to appreciate, while risk-on assets like emerging market equities suffer outflows. A well-timed shift into high-quality sovereign bonds from stable economies, or into commodities that are less directly tied to oil, such as gold, copper, and agricultural products, can provide a buffer against the volatility that would ripple through European stock markets. Moreover, investors should pay close attention to the insurance sector. Marine insurers, for example, will likely raise premiums on shipping routes that pass through the Strait of Hormuz, and those cost increases will flow through to the price of imported goods across the continent. There is also a growing conversation about the role of sovereign wealth funds and pension schemes in mitigating the shock. Large institutional investors in Europe have begun to adopt more robust stress testing frameworks that incorporate geopolitical scenarios, including rapid changes in leadership within major oil-producing nations. By running these simulations, fund managers can assess how a sudden spike in oil prices would affect the solvency of pension plans and, in turn, the retirement security of millions of Europeans. The outcome of those tests often leads to a preemptive reallocation of assets toward lower-risk holdings, a move that can help smooth out the impact on ordinary households that might otherwise see their pension payouts eroded by inflation. On the ground, the everyday European will feel the shock in several tangible ways. Higher energy bills are the most visible symptom, but the ripple effects extend far beyond the thermostat. Transport costs will rise, meaning that the price of a commuter train ticket or a liter of gasoline could increase noticeably within weeks. That, in turn, pushes up the price of goods that rely on road or rail logistics, from fresh produce to manufactured electronics. Households may notice a subtle uptick in grocery receipts, especially for items that are imported from regions that rely on maritime freight. Restaurants, delivery services, and even e-commerce platforms will feel the pinch, and many will pass those costs on to consumers. Another less obvious effect is the potential tightening of credit conditions. If central banks decide that inflation is moving beyond their target bands, they may raise interest rates more aggressively than previously planned. Higher borrowing costs will affect mortgages, personal loans, and business financing, slowing down consumer spending and dampening investment in new projects. For small and medium-sized enterprises that operate on thin margins, that could mean postponing expansion plans or even cutting staff, which would add another layer to the economic slowdown. The question of preparedness, then, hinges on both institutional readiness and individual resilience. Governments can only do so much. Much of the mitigation will come down to how quickly businesses adapt their supply chains, how investors reposition their portfolios, and how households manage their budgets in the face of higher costs. In many ways, the scenario we are exploring is a stress test for the entire European economic fabric, and the outcomes will reveal both the strengths and the vulnerabilities that have been hidden beneath the surface. So, what can you do right now to protect your financial well-being? First, take a hard look at your personal energy consumption and see where you can shave off waste. Simple actions like improving home insulation, switching to energy-efficient appliances, and reducing unnecessary heating can add up over time. Second, review your investment allocations. Ask yourself whether you have enough exposure to assets that traditionally hold value during periods of market turbulence. Third, keep an eye on policy announcements from the Bank of England and the European Central Bank. Their forward guidance will give clues about the direction of interest rates and the likelihood of emergency liquidity measures. Finally, stay informed about the geopolitical developments in the Middle East. The more you understand the underlying dynamics, the better positioned you will be to make proactive decisions rather than reacting to sudden market swings. Before we wrap up, I'm curious about your perspective. Do you think Europe's energy diversification strategy is moving quickly enough to offset a potential shock from the Gulf? Or do you see a greater risk in the financial markets that could spill over into everyday life? Drop your thoughts in the comments below. I read everyone and love to hear the different angles you bring to the conversation. If you found this deep dive useful, please give it a thumbs up. It really helps the channel keep delivering these detailed analyses. And if you haven't already, consider subscribing so you won't miss the next episode, where we'll explore how other regional powers might react to a leadership change in Iran and what that could mean for global trade routes and security alliances. Stay tuned, stay informed, and as always, thanks for watching.